Hi, my name is Darren, and this is HCJ.tax, and we're a team that seeks to demystify that sometimes confusing world of international tax. And today we again have the honor and privilege of having a conversation with the one and the only Mark Morris. Mark, can you please introduce yourself?
Yes, I'm an expert in automatic exchange of information and exchange on demand, and I've been consulting for the OECD and the EU Commission and the EU Parliament since the days of the EU Savings Tax Directive in 2002. And I've done nothing else for 25 years but focus on exchange of information. And I give seminars and websites, etc.
Okay. So again, sticking with CARF, when we spoke about confidentiality strategies in the last video. Is this strategy permanent, or do you think it's like a temporary planning opportunity that might soon close?
So the jurisdiction that I use, which will be permanent, is a territory of Norway called Svalbard.
Right.
And that will be permanent because
Mhm.
the tax treaty of 1925, which is 100 years old, said that all signatories, and there are 48 signatories, including Russia, China, North Korea, the main article of that is that all signatories must be treated the same for tax purposes, and that tax must be only used for Svalbard and nothing else. So this will never change unless you got North Korea, China, Russia, and the 48 other countries that agree. Okay, so there's no tax agreement between Svalbard and all these other countries. Sorry, Norway excludes every country in the world that it does a double tax treaty. It excludes Svalbard because of this article that they must all be treated the same. You can't have, let's say Norway had a double tax treaty with one signatory country, South Africa, Yugoslavia, well, in any Germany, then that country would have beneficial advantages over countries that don't have a tax treaty. And the article of the Svalbard Treaty, which recognizes Norway as having sovereignty, says that all those signatories must be treated the same. So you can't have one country doing a tax agreement. So that's going to last forever. So there are other structures that I think will last forever, such as using a UK non-resident trust as the custodian institution. And I don't see the UK getting rid of their non-resident trusts.
And yeah, we've spoken about that on several occasions. It is a fantastic. Obviously, the UK as a jurisdiction isn't tarnished like some of the other smaller islands. Their reputation may be struggling.
The territories, the other territories, yeah.
Yeah. And then the compliance burden is next to non-existent legally. It does need to register with TRS.
Does not register with TRS, does not register with HMRC, and does not register in Norway if the trust doesn't have a Norwegian bank account or own Norwegian property. So it's not registered anywhere. Whereas, let's say I take Jersey or Cook Islands, they may say, we don't have a central register, but the beneficial owners are registered, maybe with the trustee, and that information can be retrieved via exchange on demand. Whereas no country can ask for about exchange on demand because they're not part of the OECD multilateral competent authority, and there's no tax agreement to issue an exchange on demand.
So interestingly enough, as you mentioned, Cook Islands, I was speaking to a tax professional from New Zealand. Of course, the Cook Islands is like a dependency of New Zealand. Yes. So he was mentioning as a result of a loan or some sort of financing agreement between the Cook Islands and China, there is concern that the information from financial institutions in the Cook Islands or fiduciaries in the Cook Islands is actually being sent to China.
It's called exchange on demand. Forget automatic exchange. And exchange on demand is far worse than automatic exchange because they can start asking, when did this money come from? All in one shot. When did it arrive? Who did it arrive from? And because it's tax related, and it's written clearly in the multilateral competent authority agreement, which 179 countries have signed. So therefore, 179 countries can issue exchange on demand, but only 115 have joined CRS and only 69 have joined CARF. So to me, exchange on demand or exchange on request is really the killer in confidentiality.
Absolutely. Okay. Thank you very much, Mark. So, Mark, if anyone wants to reach you and contact you to find out more about these tax planning and structures, what's the best way to do so?
Well, it's easy to just Google Mark Morris CRS or Mark Morris Automatic Exchange, but my website is www.co-ownershiptrust.com. The co-owner has got a dash, a hyphen.
Okay, thank you very much for that.
But it's easy to find me just Googling me, Mark Morris OECD, Mark Morris. I've got articles on The Economist, and it's easy to find me.
Fantastic. Thank you.